Welcome back to another Future Way video. Today, the video will compare the differences between swap fees and funding rate. The finance world is constantly evolving. New financial products continue to be produced, and is happening faster than before. Trading had evolved from using price patterns to quant traders, which uses big data to execute high-frequency trading. 20 years ago, the product like cryptocurrencies are almost a science fiction. In the present, we are in the midst of Bitcoin reaching the 6 figures mark. Hence, it would be illogical to buy it using spot trading alone. $50–60K per Bitcoin almost costs an average Joe's yearly salary. Buying a whole Bitcoin is like a lump sum investing for most retail investors. Hence, some traders or investors harness the beauty of leverage. In finance terms, leverage employ borrowed funds for an investment in the hopes of making profits that exceeds the interest paid. However, this will generate debt for most investors, so I would suggest to use leverage in another definition, which is make the most of something. For this video, the something is called futures trading. But before that, let me explain the terms spot and futures trading. Spot trading involves buying the financial instruments by having them physically. For example, investor buys 0.15 Bitcoin and same amount was credited into his wallet. And if you are buying gold necklace, you are able to wear or hold it with your hands. It means you own them physically. You do not need to pay swap fees for holding the stocks, crypto using spot. On the other hand, futures trading involves buying contract to trade an asset without owning them physically. You are using borrowed money to trade the assets. If you want to trade oil, you don't own the real oil but instead using contracts. In futures trading, you need to pay a swap fee for holding them for a period of time. Back to the main topic, swap fee is a term used in forex. It refers to interest traders earn or pay by holding the positions overnight. Swap long for long positions while swap short for shorting the assets. In cryptocurrencies, funding rate is the term for swap fee. Perpetual futures give traders ability to keep their positions overnight without an expiry. Binance uses this often and calculated every 8 hours a day. Hence, a futures trader need to consider the funding when opening a trade other than being liquidated. This rate changes over time and is not fixed. A positive funding rate is defined as long positions traders pay shorts. It means that a long position trader will receive a penalty for holding their positions. A negative funding means that short sellers pay long traders. It means the long position traders will receive positive interests while holding their positions and vice versa. Hence, cumulative profit is equal to position and profits, plus positive or negative interests. Next, cross margin means you share multiple open positions with total capital in your wallet. While isolated margin means you allocated a fixed amount to trade and only that specific amount is eligible to be liquidated. Reducing leverage means that you require higher initial capital to trade, while increasing leverage means requiring lesser capital to trade as low as $100.
Stay safe and invest safely.